This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization. Channel surfing, video number 1, basic concepts. Channel surfing is a method of using channels to establish the parameters of a market, to determine its bias, and to set up certain trade signals based on price reaction to those channels. For example, in this market of the S&P E-mini on the monthly time frame, we can use channels to establish certain parameters. And if you look at this market, you no doubt notice certain aspects of it. For example, you have a nice strong swing to the downside here, and it turns around and makes a very strong climb here. If you sold within this area, well then obviously you would do quite well. If you bought in this area, well then again you would do very well. So how would the channel lines or channel surfing help us in this regard? Well, let's set up a channel and see what we would come up with. A channel is really nothing more than an extension of something you're probably already familiar with, that of a trend line. And you can see this trend line in place creates a parameter where the market changes direction right here. If you had sold up here at any point, exiting out within this area would of course have been a nice profitable move. So we can see the value of a trend line. But with channel surfing we go a step further. You see, we're not just setting one line, we're also adding a secondary line on the opposite side. And it can be applied to multiple lows or multiple highs, or it can be a duplicate of the original line. And we'll talk about the difference in a little bit here. This downtrend establishes the parameters of the market. Now, both have their advantages, and we'll talk about them in different market conditions. But let's take a moment and look at the uptrend and see how we would apply the same thing. In this case, in the uptrend, we again have a break right at this point, which means we would have exited at that level. So if we had bought within this point and exited out here, obviously it would have been a very profitable position to have taken. In this case, again, we would use a duplicate line. Now, because we don't have the same parameters available as we do in the downtrend or these lower points, we can simply duplicate the line and use this, and we'll explain the difference later on and how they apply. Now, through the trend, you will see that there are different swings in the market and different points where we can establish or set up other smaller channels, and they have their importance as well. One key point that we want to make in regard to drawing these channel lines is to be cautious about what you use to apply a channel line. For example, some may be tempted to simply use something like this, where you see multiple lows straight off, continuing without let-up. That is not a very effective point to use, or combination to use for a trend line, or to establish our channels. The ideal situation is where the market actually swings back in one way or the other, creating a zigzag pattern in the overall direction that it's moving. Doing so, it sets up an extreme, and that's what we're after. We're looking for the extreme of the market. When we have the extreme, well then obviously when it exceeds that extreme, then we know something has definitely changed. The market has a tendency to follow through on certain parameters. And when that progression changes and it exceeds those parameters, it's an early warning that the market has changed direction. So how do we apply this in regard to trading? Well, first off, let's talk about the channel lines and certain aspects that apply to them. Before we go in any detail about how you set these lines or how you interpret them, we want to talk about the lines themselves and what they mean. There's a couple of terms that we use in reference that are unique, and you'll understand later on as to their importance. But we want to direct your attention to the lines themselves. Now, obviously, in regard to any trend or trading range situation, there is an upper line, as you see here in this downward trend, and there's a lower line. In the upward trend, we have an upper line, we have a lower line. In a range-bound situation, we have an upper line, as we see here, and we have a lower line, as we see here. In the case of a trending situation, we have another term that we use quite frequently. And there's a reason for it, as you understand later. That is what we refer to as the inside line and the outside line. Now, what does that mean? The inside line is the line that's closest to future data. In the downward trend, as we see here, this would be the upper line. But in the uptrend, the inside line that's closest to the future data is the lower line, so they reverse roles. The outside line is the line closest to the past data, meaning that in the downward trend, it is the lower line. But in an uptrend, it is the upper line. Now, why do we use the term inside and outside? It is because the role they play. The inside line is the line that actually creates the directional, or is what's responding to the activity of the market. In the downward trend, as we see here, the upper line, which is our inside line, creates a pushing effect, causing the market to go down. It is the limit, and it plays an important role because once that line is broken, the future of that trend is now in jeopardy. And so it's a critical line that, when violated, is of importance to us in relation to how we interpret the signals. The outside line is what, kind of supports the downward trend. It is the extreme that it's moving to. And while it does provide important signals, it isn't established because it is pushing the market. Rather, the market is pushing it. And it responds a little bit different and plays a little bit different role. The same thing is true with an uptrend. Again, the inside line, which is our lower line, as we see here, pushes the market higher. Now, in reality, we do want to emphasize this point. The lines themselves don't establish a trend. Price establishes a trend and its activity. The lines only establish the extreme parameters. And so the line themselves monitor the activity, or what's creating the force within the market. And that's why it's important to know the reference between the inside line and the outside line. The outside line simply follows it and creates the extreme that it's going to respond to. Now, while it's not exactly clear as to why we use these references, later on you'll understand, because it makes it easier to reference how we respond to the signal without any confusion. Because obviously the upper and lower lines are opposite between a downtrend and an uptrend. So therefore, we need to use a different reference so we're clear in referencing both trends, up or down, in the same exact way. Before we move too far along, I want to repeat something for emphasis and clarify in regard to how you draw the lines. Now, while we will detail some more information about drawing lines a little later, we want to make this point. There are many places that you can actually draw a line with multiple highs and multiple lows. For example, you can draw a line right here. And you can see that there are multiple highs here. There's a slight separation where a couple of highs don't touch the line, but they're pretty close, as they say, close enough for government work. And it's not till we get to this point that the market separates from it, leaving a couple of highs a good ways away from that line, and then returning to it. Now, this is an important example where the point is well taken. When you're dealing with multiple highs that continue to touch a line, there is significance to the line. However, it is still a weak line. It is not until you see a separation, as we see here, and that it returns and then bounces off of that, that it establishes a stronger line. And if you look at the original line we drew with this high and this high, this is even a stronger line because the market separated for such a great length of time, returned and bounced off of that point, and then proceeded to continue the trend, making that line an even stronger line. That's why in this case, when we broke it down here, it was so very important as a signal. The point is that the longer and greater the market separates from the line yet react to it when it returns and continue the trend, the stronger that line will be. And so when broken, plays a much more powerful signal role in our trading. And so when you're looking to draw these lines, while there's nothing wrong with using multiple highs or multiple lows in line with one another, they do have their value. The fact is, the more separation you have, that in particular is what you want to be looking for and what you want to be noting in regard to your trading and drawing these channels. An example can also be seen in the uptrend. You can see that the market has, for example, multiple lows here. And we can have points where it establishes, and multiple lows where it separates is important. It establishes the trend. However, the fact is that this other line that we have, as we see with this low and this low, the market separates so long and so far that when it breaks actually earlier and with much more force. We can see multiple lows established here that it repeats in regard to responding off of. And when we break, that plays a role as an important signal to change the position you have in the market. And so you want to pay attention to the ones that are further out, longer separated, deeper activity in regard to the price. And by deeper, I mean that goes further away from the line, as we see here, rather than just this loop. And these are the points or the areas where the line will provide a much stronger signal. So even when you have repeating points, you want to take note of the ones that are farther out. Now, repeating points, as we see here, will tend to give you greater strength than the multiple highs as we see right here. So there's a degree of difference in each situation, and you'll learn to understand the difference as we go through some examples later. But bear that in mind in drawing the channels. One factor that comes into play here is that not every situation is going to provide you with multiple highs and lows, at least on both sides of a trend, particularly true early on in a trend's formation. How do you know how far the market's going to go? How do you trade that? Well, let's take a couple examples. I've removed the lines off of this chart, and we're going to show you some examples of what to do. Now, we already established a little while ago that this was a trend that quickly established early on in this market. And we can see the multiple highs that form, and the market even drops down lower, separates, and comes back out, and bounces directly off this line again and starts to decline. Now imagine for a moment you're right here, and you're seeing the market to decline, and you want to short the market. So you sell. But wait a minute, you only have one low to work with. How far is the market expected to go? How do you determine or use the channels to help you out there? Well, look at this little trick that we use quite frequently. When you don't have multiple points to work with, only one point, then simply duplicate the line and apply it to that high or low. And as you can see, it provides you with a key exit point in order to lock in your profits before it responds back up. The application of this applies in many ways. For example, if you look at the uptrend that we have here, we see the market, how it rose up here and then decline. How far was it going to decline? Could we have any kind of estimate or expectation of how far this thing would drop? The answer is yes, but let me show you in this way. Notice this high applied against this high, and if we duplicate this line and apply it to the low, well, guess what? We're right within a very, very narrow margin of this line where it reacts off of. giving you a great opportunity to buy into the market and take advantage of the upswing as it begins. And all we did was duplicate this upper line and apply it to the lower end, as we see right here. So when there isn't multiple highs and lows to work with on both sides, then take one line that is established on one side, duplicate it, and apply it on the other. It's a great start. Now, eventually, there will be points that establish within the trend in multiple fashion. When it does, then that's what you want to focus on and adjust your lines accordingly. But until that time, this is a great technique that you're allowed to use, and we strongly recommend you do use in many applications, particularly when a trend just begins underway. The same principle can be applied to trading ranges. Now, trading ranges are really a situation where the market is bouncing between two price levels or similar price levels, and you have multiple highs at one certain price level, multiple lows at another price level. If you look at this market, technically, we do have that. We have two highs that are very similar. And so a bit of a trading range is established. Now, in this case, we have two highs, as we see here, but we only have one low. Still, because we see signs of a trading range here, we can still apply a line down here off the single point. Not necessarily establishing that this will come all the way down to this lower line, but it very well could. Certainly the parameters are established allowing to do so. In any event, the key is that when you start seeing multiple highs and multiple lows at the same level, even if they're not exact, because technically we do have a slight incline, you can duplicate the line again as we did on the trending situations and apply it on your trading range. There's nothing wrong with doing that. And take advantage of the levels that provide a signal that you can use in trading, both in buying and selling the market. When a trend gets underway, it has a natural tendency or a natural phenomena of increasing or accelerating. Channel surfing is uniquely qualified to exploit that. When we draw our lines, such as we do here in the US dollar weekly chart, we end up initially with a line like this. As you can see, the market accelerated at one point, and when it came back, it didn't quite make the point where the line actually was. Same thing here. It accelerated. So therefore, we can add an accelerated line by adjusting our points that we use. And you can see where the line has a greater decline. Now, even at this, we note later on that, again, we still have a situation where the market does not reach back up to the line. It has accelerated even more. So we would continue to fan our line to increase its acceleration to cover that difference or that change in momentum, thereby locking in our profits much faster if it's ever violated. As we look at the market, we can use this actually in both sides. And so let's take a moment and apply each line on the lower end and see how that would impact our end result. For example, when we take our first line and apply it to the low, we can see the market moving down and touching this lower line and then reacting. But it did move rather deep into this area. If we take our second line, which is accelerated, we can see that it's much more in line with the lows that form right here when the market reacted. A great profit-taking opportunity. As we look further down and take the line, we can apply it again, this time on the last low as we accelerated, and we can see where the market just came so very close that it almost touched that line, again signaling a point where a profit could be taken. Now, we will go into how you interpret the signals a little later on, but you can see the advantage of accelerating the line, and this is what we refer to as fanning the line. Acceleration lines are an important concept for channel surfing, because as the market increases its momentum, We want to be able to trap that profit whenever there's a sign or indication that that momentum has come to an end. And by accelerating our lines and adjusting the channel lines, we can do just that. When using channel surfing, you will run into a number of special situations that you need to be mindful of. We want to mention one in particular early on, and that has to do with blow-offs, because they skew the actual geometry of the market. Now, what's a blow-off? A blow-off is an extreme where the market peaks at a high or low and the market reacts very violently. One typical characteristic is that they are an extreme move for the market. You'll find the bar or candlestick much longer, typically, than most that you see within the market. This is true here in this market of the euro against the USD, a forex market, and on the weekly time frame. We see one such example right here with this bar, right here, where it peaks. The high and low are rather extreme. Very few, if any, bars that you find on this market match it in length. It also has another characteristic that gives it away. We see the market opens low, peaks so high, and then declines rather rapidly to close low once again, showing that there's no real sustenance to this actual bar. It's just a blow-off. The market reacts violently to that as well. Now, why is this important to identify? Well, let's draw our channel lines and see. Normally, we would start with the high or low, and in most cases, that's the way that you will draw your lines. It's just you have to be careful about these blow-offs. Typically, you would draw the line like this, using or taking advantage of the last high that is able to touch. And if we look down, we can see the market does, in fact, react to that line in this series of pullback that we see occurring here. So it does have validity. But note, too, that after doing this, the market actually breaks this line, peaks a little higher, but still continues to move downward afterward. Now, what happened here? Why didn't we get the actual high? The problem with this was that it skewed because of a blow-off. In this case, our focus needed to be on the prevailing highs that followed and excluded that first bar, as we see here. And we can see that there's a series of highs here, a high here, and a high here, and that leads to exactly where the market reacted over here. So blow-offs are something you need to be mindful of, and they're not hard to identify, but you still need to learn to identify them, and they have certain characteristics that make them stand out. So keep this in mind when you apply channel lines. Now that we understand how to draw a channel line, let's look at how we would use that to generate a signal for trading. The first thing we're going to look at are exits, so we're going to focus on that first. And I've taken this example, the live cattle daily chart, because it has a rather narrow trend here. Strong downward trend, but still narrow. So we're going to start with that type of situation first. When you generate a channel line, obviously you're going to use the points, the highs that are generated. Now there is some separation. You can see that the market moves down and separates here, but then we cross over this one. And if we take the last point here, where it finally drifts away and doesn't come back and exceed that until much later, we can see that we have pretty much the line in place. Now we can draw a line on the lower end, as we see right here. And we're going to start with this first, where we actually draw a line. But I'm going to show you in a moment a situation where we have an accelerated situation and just duplicate the line. Now the way the exits work are very simple. You exceed a line and then you exit. And that applies to either line. So if we exceed this line here, well, we're going to exit. If we exceed this line here, well, then again, we're going to exit. Now, the first thought that might come to mind is, why would we exceed on the lower line? Aren't we moving in a favorable direction? Well, the reason is that typically when we exceed, touch, or in some other way violate that line, typically the market reacts and goes the opposite direction, as you see here. In fact, you see that right at this point where we've drawn a channel line where the market exceeds it and it reacts and changes direction. Now, imagine for a moment that you had short or sold this market, and because of the channel lines, you're looking for an exit. This is what's indicated. Could you have gotten any better exit than this? No. Absolutely the best exit that you could possibly have taken. But let's say it doesn't exceed that channel line. What do you have as a fallback or a backup in regard to exiting? That is a violation of the other line. If we exceed this line, as you can see, we would have exited out about here. And if we had sold anywhere up in this area, well then again, it would have been a good exit and a good profit. So we have two lines to work with on an exit. Now we do want to make a point that in many cases, when it comes to the inside line, which is this line here, remember, to the right is an inside line, that we want to look for a close beyond that, not just a spiking through it. And we'll talk about that in some detail later on. But exceeding the other line, we want to take an exit even if it doesn't close beyond it, because we are expecting a reaction to that. And the reaction would be against us, whereas if it failed to hold beyond the line here and reacted to that line, well, typically it's going to carry in our favor. So thereby, we want to focus on the close in the violation of the inside channel line, but on the outside channel line, which is the one to the left, we want to exit once it's touched or violated, and particularly if it shows any indication of a change in direction, as we see with this green candle right here. So basically, that sets up the exit. Now we're going to focus in on another aspect, and that's duplicating the line, and see how that will differ in our signals and how we would interpret this. Now, if we take this line and duplicate it rather than adding our own line, what we end up with is a very similar situation as we had before when we drew a line. In this case, we're going to apply it to the low, and you note that the market touches and it actually slightly exceeds that line, again signaling an exit. So even in a duplication of the line, it works quite well. This is also true as it accelerates. Note, if you would, that right about here we have an acceleration of the market. It's actually angled a little bit steeper than our original line as the market proceeds with the last half of its decline. Even if we take this line, and I'm just going to move or shift this to the low that's in line with that accelerated action, again, it ends up just where, and I'm going to remove this line so we can see this quite well, where we saw the other one. Again, it's touched by the bar that actually reverses the market and it changes direction. Again, a great exit. And that's the key point. Even in a duplication, you find that this is quite effective. Now, there are special situations that you're going to have to be aware of that we'll get to a little later. But just to reemphasize the point, when the inside line is violated, and ideally you want to close beyond it, then it's a signal to exit the market. If the outside line, which is the one on the left, is touched, even though it's not a close beyond it, just touched, then it is a signal to exit also. So when these lines are violated, you want to take an exit. But in the case of the inside line, you have an opportunity to give a little bit more leeway or room to actually close beyond that line and establish a change in direction. And we'll refine that application of the exit a little bit later, but that it basically covers the point of how we would apply this even if we duplicated the line rather than actually had a secondary line that we could draw. Now, in the case of a market that has a wider trend, the principle still applies. For example, here we can draw a line and we can see how this one lines up so well and is violated at this point. Obviously, an exit would be taken right here. But it also applies on the outside line, where we can duplicate this and place it to the opposite side. And note, if you will, that again, here the market touches just before it reverses direction. And so, again, that would be a key point for an exit. There are, of course, lines we can draw to establish the end of the trend as well, and you can see where it's violated right here, which would signal an exit as well. So in either case, ideally, once you have the lines in place, when they are violated, you have an exit. It doesn't matter whether it's a narrow trend or a broad trend. The principles still apply, no matter what time frame you're dealing with. This is the rules and the way that an exit is handled in regard to channel surfing. Channel surfing, video number 1, basic concepts. All methods and techniques are those developed by Michael J. Parsons. The videos are narrated by Michael J. Parsons. Director of Marketing, Osman Musa. Technical support, Melissa R. Parsons. Accounting, Ruth E. Parsons. And translation, Heather L. Parsons. This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization.